Affordability is front and center this Thanksgiving week, and restaurants across the country are working to navigate rising cost pressures. Joining us right now is an analyst who covers the sector, Jon Tower, Citi's restaurant analyst. And Jon, we talk about inflation all the time. We know that it's real. We feel it for sure over the last 5 years or so. But where are you in terms of measuring its impact on restaurants and consumers at this point?
Yeah, well, it's been coming down relative to where it had been, say, 5 years ago. In part, wage rates and wage rate inflation specifically has been coming down relative to where it had been. And that had been the predominant factor in, frankly, driving that inflation and prices at restaurants higher over time. Food input prices have also been a factor there as well, but those have been moving lower. Generally speaking, beef has continued to be a bit of a burden for the restaurant space, but that's been moving a little bit lower too lately. Depending on the different cuts, steaks themselves continue to be a bit of a pain. And I don't see that necessarily getting better anytime soon. But with the tariff reductions that we just saw come through, the ground beef and such, that should actually start getting better. It's actually starting relatively soon. We'll see it in the grocery channel. We'll likely see it at the restaurants start flowing through, I would think, starting early in 2026 at the restaurants.
You upgraded your rating on Brinker to a buy yesterday. Is that part of the reason behind that, the lower prices because of the tariff reductions?
Yeah, so part of their they had raised their expectation for commodity inflation in the back half of the year, in part due to tariffs earlier in October. And now that was reduced as of last week, it was ground beef inflation. They source a lot of it from Brazil. Now that that's going away, that's going to be nice cost pressure that won't be rolling through their business any longer. On top of that, their sales are just crushing it at the moment, and it looks like that's frankly going to continue. They've found something, a great recipe in terms of communicating with guests through everyday value, as well as a great restaurant experience. And they're really communicating well with younger guests these days. Some of the research that we did is not only are they speaking to the younger guests more often, they're speaking to them in the channels that they are frankly looking at, and they're coming in more often and they're spending more on a regular basis. So we felt like that provided a lot more visibility into traffic growth into the future for Chili's. So yeah, we like that story. We think they have good line of sight into that persisting well beyond 2026 here.
How do you separate the winners from the losers? And I think through what we heard from Chipotle recently, where they said that households that were earning below $100,000 a year had cut their visits pretty sharply. I think through what the Cava CEO told us here on Squawk Box when he said that younger consumers had stopped spending as much, too, had stopped coming in as frequently, even when they were asked to do things like pay back student loans and things. How is Brinker able to capitalize with that? What's the difference? And how do you separate who is hot and who's not?
So it depends on short term, long term, right? I think in the near term, what's really resonating is occasion based dining and those that are offering an everyday value price point and messaging that exceptionally strong with some new product news, right? And I think Chili's is hitting on all of that. And there's a few other brands that are doing that exceptionally well, too. And so, unfortunately, for some of the fast casual brands, they don't necessarily, that's not their wheelhouse, right? They're not necessarily on air with a price point, nor are they necessarily occasion-based dining. I mean, sit-down dining where you're having a server come to the table and bringing you a meal. That seems to be resonating well these days with younger guests. And keep in mind, those occasions are, the average casual dining restaurant, you're only going roughly 2 to 3 times a year at most of these chains. Whereas when you're thinking about a fast casual restaurant or a limited service restaurant, most of those chains get roughly 8, 12 visits a year. So when a consumer decides to cut back one visit a year, that can be fairly impactful to those chains. and it's a relative game here of traffic changes that's really impacting the fast casual and limited service space at the moment, and it seems to be shifting more in favor of casual dining at the moment in time. In the future, I still think fast casual is going to do relatively well, right? They still do exceptionally well on convenience. They're really well on food trends. And frankly, the box economics do exceptionally well across the board, whether it's Cava, whether it's Chipotle, and they're really well, they do exceptionally well in terms of marketing. So I think over time, those brands are going to continue to grow. I think they're going to continue to stay attractive to younger guests and older guests. And, we're in a bit of an air pocket at the moment, but I think it's the economy at some point in time starts improving and jobs start growing again, those brands will start doing well, traffic will start recovering.